This is the London Fintech Podcast, brought to you by your host, Mike Ballerman, bridging the worlds of suits and t-shirts, of finance and technology, bringing you insights, stories, and inspiration from the golden age of opportunity and innovation happening in London right now.
Hi, this is Mike Ballerman, and this is London Fintech Podcast, episode 117, brought to you in association with Blue Motor Finance and Smart Pension, and I'm delighted to be joined today by John Goodall, CEO and founder of Landbay, to talk about the changing tides and winds in new FS versus old FS lending. How are the incumbents and the newbies doing? How is the balance of funding of P2P between institutional and retail going? When does accepting institutional funds turn into just being a front end for old FS? John was last on the show way back in LFP117 in 2015, talking about that rare topic in fintech, actual stress testing and determining real downsides, as opposed to propagandizing about upsides. Like all guests on the LFP, he has only gone from strength to strength as a direct result of his appearance. Landbay are that rara avis, a firm that not only talks about specialisation, common, but far rarer walks the walk as well as talking the talk very successfully, as evidenced by them winning the Best Buy-to-Let Lender of the Year award last week, ahead of Barclays, Lloyds, etc., as well as being number 20 in the Deloitte's UK Tech Fast Tech 50. Landbay only do buy-to-let mortgages, and since their first loan 4 years ago, have done nearly 1,000 loans with a total length of over £200 million. The smart listeners out there will be able to divide roughly 200 million by roughly 1,000 and derive that their average loan is around £200,000. Their average loan-to-value ratio is just below 70%, which shows their conservative lending approach. The impact of this is evidenced by a stat which sounds pretty unique to me in the sector of 0 loan losses to date. That's truly amazing, and congratulations to the whole team. As I've mentioned before, risk is generally much misunderstood. At a simple level, the mathematicians often overlook the ubiquitous feature of life called the cock-up. Simply not cocking up when you do something 1,000 times is great going. Plenty to talk about, so let's get on with the show. Hi John, thanks for rejoining me today.
Thanks a lot, Mike, and it's a pleasure to see you again.
Yes, and I should do more podcasts with you or get a job with you because you are extremely well located, being in the building which is roughly nearest to the platform on which my train arrives at Victoria.
Yeah, you're always welcome, Mike.
Well, I need a job. I need a job at this rate, so I shall talk about that one later. Now, talking of podcasts, and you've moved from being round the corner because you've always been in Victoria. It was interesting when we were chatting before. You were saying that you remember talking about taking your son to school the first day or something like that when we were on the show last. And it's an amazing thing about doing podcasts, actually, which is that generally all guests remember where they were and some of the things they were saying, and I didn't have to close my eyes. I can remember the room we were sat in, even though it's over 3 years ago. It's a very strange thing, actually. I think maybe there's a heightened state of awareness when you turn microphones on or something like that.
Yeah, exactly. And it was his first day at a certain school, so it would have been September 2015, if that's right. Does that work out?
Yes.
I think that's right. And I remember that room, and that was obviously we had a pretty small office then. I think we had 20 desks in one meeting room, and now we're in this place with 4 meeting rooms and about 60 desks.
And what's the staff numbers?
We'll be just under 60 by year end. It's obviously end of November now, so we've got another 3 weeks of the year in terms of when we sort of pretty much stop up for Christmas.
And in terms of children growing up, you were saying about choices between schools and all that inevitable stage. As listeners will know, I've got to the sort of relatively joyous stage, which is that the kids are at sort of university. I think there's a less joyous stage which is that they fail to get jobs that make enough money to be able to live, so they come back home for some time. But your son's looking at sort of mixed schools, single-sex schools, schools here, schools there.
Yeah, so it's funny because we're going through that process now, and obviously when we last spoke 3 years ago, we'd been through one school, and it's amazing how we're getting to the end of the school he's currently at, and so we're looking at the next stage.
And he's about 12, you say?
He's about 12, so he'll move when he's 13 in a year and a half. And he wants to board. And I think our daughter does as well, who's 9. And I don't know whether that says something about us as parents, that they kind of want to move out earlier than when they go to university or, like you say, when they start work. But my wife and I are quite happy to let them go off, and we're looking forward to having a bit of time for us.
Yes, exactly. Well, Bridget and I have had to wait sort of another sort of decade longer to get to the sort of bit of freedom. I mean, actually, I think there should be a conspiracy theory going around, because it would definitely have a lot of evidence, which is that the whole Harry Potter books and then the Harry Potter films were funded by the Boarding Schools Association, because I think that has been genuinely one of the biggest flips, has really sort of changed the sort of attitudes of a generation to somewhat romanticise, or at least, should we say, advertise or publicise the benefits of boarding school.
Yeah, I think that's fair. I mean, Deloitte's a school in central London, actually, and our daughter Agatha is too. And obviously, because it's central London, there's quite a lot of Americans and European children, or children with parents who are, one European, one American, or whatever it may be. And when we say, we're thinking of sending our children to boarding school, sort of the look on horror by the sort of average American, French, Italian, it's like we're just, it's almost child abuse. So I think boarding seems to be very much a cultural British thing. I mean, I went to boarding school, a lot of my friends did, and no one batted an eyelid. But actually, it is a subject that actually divides people quite strongly.
Yes, people get very emotive about education, don't they? I mean, of course, the genesis of all this was the imperial days when a lot of British people were abroad, and you sent your sort of kids home and all that kind of stuff. I mean, just in terms of the boarding school people I met, I think that just empirically, in terms of decades later, what I just sort of notice is that for the majority of them, it was a very good experience, and they end up sort of stronger and more robust people as a result. You do meet the tiny minority, shall we say 5%, that actually somewhat didn't work out, to be polite. They're sort of bitter and twisted ever since, kind of stuff. Yeah,
but I suspect that's probably true for day schools as well. I think
yes.
In most cases at well-run schools, the majority will enjoy school, but there's always been a minority that just actually
hated it,
got
picked on.
And every school has some element of bullying and problems at every school, and I think all schools have got better at pastoral care, but it's never going to be perfect.
Yes, indeed. And you were mentioning that you were a teacher yourself, actually, which I didn't know. I did know one of the reasons I think you've done so well here is it isn't your first business, that you had a prior business as a headhunter. So I always assume I didn't know where headhunters come from. They maybe spontaneously generate out of thin air somewhere sort of one's never heard of. But actually you did I was about to say a real job, I don't know what's real. You did a kind of job before that.
Well, not before, actually. I went straight in as a headhunter, set up my own headhunting business, and then sold that. And then I was thinking about what to do, and actually I had the opportunity to go and teach economics at the other end of Victoria Street at Westminster School.
Which, for those people abroad who haven't heard of it, is a very well-known school and a very good school, very prestigious in London.
And I taught economics for 3 years, as it happened, during the economic crisis. It was 2007 to 2010 was when I was teaching there. And I remember actually in one of my first lessons that I was teaching, the queues had started appearing next to Northern Rock branches. And I do remember saying to a number of my pupils, Northern Rock won't go under, this is Britain, banks don't go under.
What could possibly go wrong?
What could possibly go wrong? And I say to a number of people, I think over those 3 years, probably learned more about economics than the students did, but it was good fun.
So how do you, maybe the answer is because Westminster is a public school so they can do what they want, but I was about to say, how do you sort of go from being a headhunter to a teacher? Because lots of people, and go back to sort of kids and all that kind of stuff, they then get a degree and they're going to do a PGCE or whatever, a conversion, and then, all this sort of box ticking you need to be a teacher, or was that just the state school?
So for private schools, you don't have to be a qualified teacher as such, and my understanding is a lot of the teacher training is less about teaching and more about controlling a classroom.
Crowd control, yes.
And I think partly in Westminster, and I only taught A-level, so 16 to 18-year-olds, the class sizes were 8 to 10, so it's very much like a sort of tutorial in some respects, particularly there. As you say, there's a lot of very bright children there, some who've ended up most of now who are sitting at Goldman Sachs or the Bank of England or McKinsey or something like that. And so I think, in some ways teaching at those sorts of schools, in some ways it's easier, in some ways it's more challenging because sort of questions they fire back at you pretty hard, but they are, highly motivated and on the whole pretty intelligent individuals.
Yes, interesting. Right, so that probably leads nicely actually, because I was watching your presentation, your talk last week at Lend It Europe 2018, which I shall put a link to it in the show notes, which I thought was very interesting. I had a number of sort of fascinating slides there, and I think obviously your teaching shows that it was sort of very clear and the points came over. And actually, and this leads into our main course, the one thing that kind of impressed me at a meta level about that was that you gave every impression of looking like a businessman talking about his market and strategic changes and all that kind of stuff, which I thought was pretty cool because the word fintech is a sort of shorthand for a whole bunch of stuff or really a sort of set of phenomena that have been evolving over years. But businesses such as yours, if I can call you a business, and I use that word prestigiously, businesses such as yours are businesses. you're in a marketplace, you're doing stuff, you're trying to do it to generate profit, you're trying to do it to add value for consumers and lenders and all that kind of stuff. So do you see yourself as having kind of evolved? I mean, we still use this phrase P2P, or I use it, occasionally use it P2P. Do you see yourself increasingly as just, quotes, being a business?
Yeah, and the interesting thing about not just us, but all businesses, I think when we started out, the peer-to-peer element was very, very central to what we did. And what you sort of realise very quickly is, from the borrower perspective, they don't really care whether you're a bank, a specialist lender,
everyone's money's got the same colour.
Exactly, money is the same. And so that offering you sort of don't put first and foremost. And so therefore, we are thinking really about how can we do something better than our competition, who either are banks or who are other specialist lenders or non-bank lenders. But actually, in our space, none of the rest of them are peer-to-peer lenders or marketplace lenders. And so therefore, you want to sort of look the same but better in that side on that market. And so you start to think of your competitors very, very differently. And you think, well, actually, how am I going to compete with these banks as opposed to how are we going to compete with the peer-to-peer, because actually they're not really our competition. So that's how we think about it. And therefore, we think about actually very much the buy-to-let mortgage market as opposed to the peer-to-peer market, if that makes sense.
Yes, absolutely. And in a sense, the sort of fintech bit, the digital bit, is starting to get, this sounds wrong and it is wrong, but I mean, I'll make a point, which is starting to get irrelevant, really. And by irrelevant, I don't mean that it's not important. Of course, it's the most important thing, but it's become the most important thing for every business. If you're Barclays, you need a nice app that works and da-da-da-da-da. It doesn't matter who you are, you need a good website, and you probably need a good app if you're doing something sort of useful. So this thing that used to be the differentiation, which is that, there's these bunch of cool new companies that are using tech really well. Yes, they are, but actually, even if they don't want to, and even if they're slow and sluggish, the old school have got to catch up and do that shit anyway. Yes,
I think, in most businesses or good businesses, I think the technology in many ways is under the hood. You don't see it.
It's like buying a BMW. You don't really care what's in the engine. You might be told something about it, but all you want is got the acceleration and the brakes and steering and.
Yeah, I mean, I think there is a difference for peer-to-peer lenders or marketplace lenders, whatever you want to call them, is that actually we are trying to get different forms of capital into the mortgage market. As far as the borrower is concerned, what they care about is actually how much it's going to cost me, how quick am I getting it, what the service level's like. We believe actually the model for peer-to-peer lending works quite well on all those things. You can get cheap capital, you can get a broad range of diverse capital, you can get stability of funding. So you're using the tech on the funding side, but actually, fundamentally, the borrowers don't see that. We think the business model is a competitive advantage and will be over time. But I say it's almost hidden, and I think people take it for granted.
Indeed, you make the point well. So we'll talk about Landbay little at the end, but just connecting this to you guys winning an award against incumbents, which is very pertinent to your topic of how the new boys are doing against the existing ones. So obviously there's many factors in that. Briefly, though, what are the key reasons that you did beat everybody else? Is it, and I'm sure all these are true, is it that you do one thing and you do it well? And you're just a good company, and you've got a good culture, and everybody's really focused on that kind of stuff, as opposed to being a vast organisation, 100,000 people, which is a bit diffuse and all this kind of stuff. If you were to come with sort of 2 or 3 reasons that you think that you've beat the competition as you have this year.
I think the core of it is around specialisation, and not the specialisation per se, but because of that, we hire people that know buy-to-let really well. So in terms of old-fashioned credit people, all they do is buy-to-let underwriting, whereas most of our competitors don't. They do a bit of mortgage, they do different types of mortgage lending. That applies to our sales force. It applies to everything that we do, which is very, very focused. So I think that specialisation, which leads to focus, is part of it. I think being a smaller challenger, like you say, I think just culturally as an organisation, people are more motivated. Everyone in our business has options. And I think actually my background as a headhunter helps, because I focus a lot on hiring and hiring the right people. My general view is if we get the right people on board, we set them up and we sort out the capital side of the business, then just let it run itself. The market we're in is a big, big market. And actually, so being in a large niche market and focusing on it, I think it does give you a competitive advantage, because even on all sides of the business, because you start to get a reputation then with institutional funders saying, actually, Landbay, all they do is buy to let, they've got a good credit performance, their sales guys are very impressive, etc., etc. And you get into a virtuous circle where if we suddenly turn around and said, actually, we're going to do bridging lending, or we're going to do development finance, or we're going to do we know nothing about it. And although there's similarities, we start from scratch again. And I think you then end up, if you get that wrong, because we deal with intermediaries, i.e. that's mortgage brokers, if you get something else wrong, it then has a negative impact on your core brand, if that makes sense.
Oh, absolutely. And I'm sure you can explain it clearer than I because you're much nearer to it. In the marketplace sector as a whole, and perhaps Fintech, but to start with the marketplace, there have been others who over the last sort of 5 years started out doing one thing and then diversified, but you can't do everything well.
I think that's right. And I think the one thing you have to do within marketplace peer-to-peer is you have to scale. So there's two choices for a business in our space. You either go into a very high margin business where you're lending out at 18, 19%, and you might be able to pass on 12%, and therefore you can make high margins on what you're doing. In that sense, you don't need to be that big, but then you're in a very, very risky market by definition because you're lending at 18%. Or you can go into the sort of market that we're doing where the rates are much lower, and therefore the margins from a lending point of view are much lower, but then you have to be able to scale. And that means you need the tech, you need the automation. And actually, you have to scale in that market because actually, if you scale in another market as well, all you're doing is adding overhead because effectively you have to build a second business. And what we're doing the latter, where you go into a low margin business, it's harder because actually it takes you a long time to get to scale. And one of the challenges we had, and we knew this was going to be a challenge, when we went out and launched as a peer-to-peer, we were doing a very low-risk form of lending. We still are doing a very low-risk form of lending. But by definition, as a new company for a retail investor, we're not low risk because they've never heard of us, and how do they know we're doing it when there have been other companies like Funding Circle and Zopa who have been around for 4, 5, 6 years before us that are just naturally safer because they're established and are well-funded, etc., etc.
Yes, and so you're really talking about the sort of reputational risk in terms of actual safety as opposed to apparent safety. Of course, Zopa and Funding Circle have had plenty of losses in their portfolio. If you bought one loan at Zopa or Funding Circle, you could have lost a lot of money or the lot. And you guys have been incredibly successful. So, and I truly am deeply respectful from a risk perspective that you've done something 1,000 times and touch wood. Well, not touch wood because it's true. It hasn't gone wrong. Touch wood for tomorrow that you don't get the 1,001st or something like that going wrong. But I think that again is, it's two things, isn't it? Presumably, going back to your competitive advantages. Firstly, the underlying business model, going back to McKinsey's thing, is a very good one. You have the security of a house where there's almost 50% above what you've lent them buffer. i.e. house prices have to collapse by 30% until you started sort of worrying about security. And then secondly, you've got, as you spoke about a number of years ago when on the show, you've got the security of the cash flow coming in, so it's actually just a good business, firstly. Secondly, though, what I was referring to in the introduction, which is that operationally, you must have done bloody well because people always cock things up.
Yeah, the first bit on the credit is, so there's two bits to very simply to credit is, what are the chances of this person defaulting, and then what is the loss given default? And the loss given default on a property, it should be quite low if your valuations are good, and valuations are not a science, they're an art. And obviously property prices change over time, so it might be very different to when you have to repossess. But actually we can't control a lot of that stuff, so we've always thought, well, actually we keep LTV sensible. And so we really focus on actually what's the chance of this defaulting, if that makes sense. And that's where, we're looking at the cash flows of the business that we're lending to, that is, and we view them as businesses because they're small property businesses that effectively just rent out property. And so that's where that focus is really on that side of things. But yeah, operationally, we've taken a lot of people from, particularly within credit, from old school lenders that have good track records. And we've relied first and foremost on traditional methods of underwriting, and then thinking, right, how can we use technology to improve them, not to actually take over the credit decision, but just to build in efficiencies in the process, and also to try and remove the chance of manual screw up, if that makes sense.
Yes, indeed. And the way you're talking, and have mentioned the word fintech before, it seems to me that increasingly, certainly at the top end of the market and the other top end of the market, we're in a world where there are a bunch of businesses doing stuff, and the ones that are doing well that are up for these awards vary in terms of how long ago they started, more than anything else. It's not really a question of old and new, incumbents and the newbies and all that kind of stuff. After a while, it's just the same people going to the BTL every year, and they're just competing. The only difference is you formed 4 years ago and Barclays 400 years ago, or whatever it was.
I think that's fair. But also, and again, I think this is an advantage, is, again, I don't want to single out Barclays, but Barclays, and again, I don't know the exact numbers off the top of my head, they'll lend 3 or 4 billion a year in buy-to-let, and it may be more than that. But actually, in the grand scheme of things of Barclays, that's a pretty small part of their operation.
Expanding out then from the peer-to-peer, and banking I think is quite important. Within fintech and banking and all that kind of stuff, how do you see this specialisation thing going there? Because a number of businesses have gone down the anti-specialisation route, and perhaps those that have got zero profitability in their fundamental business model, for example, App-only Bank, a lot of them seem to be very keen to do everything, almost like sort of, lobbing your stake around the roulette wheel on all the various numbers in the hope that one of them is going to come good.
Yeah, I mean, I remember British banking is quite unique because customers, unlike in a lot of countries, are not particularly loyal. So, and what I mean by that is, if you take me, I bank with NatWest, but my mortgage is with Barclays. And I remember speaking to one senior person within a bank who's not a UK national. When he came over here, he thought, right, and he's very senior in a very large bank, thought, right, what we'll do is we're going to just aggressively acquire a lot of people via current accounts. And then we'll sell them mortgages, and we'll sell them loans, and we'll sell them all these other things. And he said, after 5 years, we realised we were giving away all these current accounts, and then suddenly their mortgages were with Halifax or someone else, or whoever it might be. And I think that's unique to the UK, not unique to the UK system, but it's very different to the UK system where, actually there's a lot of choice. If you look at the number of mortgage providers and now current account providers, people think it's an oligopoly, but you compare it to France, there's a lot more choice than people have, and they won't be loyal. And so I think you have to sort of realise that and think, well, actually, how do we want to play? Do we try and do everything? And unless you're one of the very, very big banks, I just don't think you can do that. You have to think, right, we are going to focus on one particular aspect and we're going to make money from it, because actually very, very hard, I think, to cross-sell across different product sets in this market.
Yes, cross-selling has always proved a nightmare in financial services and has never particularly worked. I mean, certainly in terms of my UK experience. Okay, so your model there is that, if I can paraphrase, and do correct me if I'm wrong, that specialisation is the best thing to do if you can do it well, and there is a good business model that you're making profit and serving your lenders and borrowers really well at the same time, then that's the kind of, almost like the first choice, really.
Yeah, exactly. And I think that's also true in the challenger bank space. I mean, there are a number of challenger banks, and there's some that, are direct competitor of ours, and they've focused very much on maybe not just buy-to-let, but they've done buy-to-let and commercial lending, commercial real estate, that is, and then a few other bits. And they are now large listed businesses that are highly profitable. And there are others that I think have set themselves up to try and do a bit of everything, that are pretty much just really a mini version of Barclays, but just very, very subscale and actually losing lots of money. And so I think it's very hard to break into that market. And I don't think you can be a generalist in today's market.
Indeed. Well, we'll see that with the app banks and how they develop in the future, because coming back to your point about current accounts, they've obviously all started with current accounts. Quite a lot of us in this world have got cards with Revoluts or Monzos or something like that. But these guys clearly need to do something that makes a profit, because doing a current account for nothing isn't a very profitable business model. So we'll see how they go. So moving on to this other point then about this whole retail versus institutional and how that's been changing over the years. How do you see how that's been changing over the years, firstly? And then secondly, on the related point, is it a kind of continuum from just taking institutional funds instead of taking retail funds to one day basically being a white label for a bank, or is there a discontinuity there?
So I'll start on the sort of retail versus institutional. I mean, it's inevitable that institutional has been a major factor in the last 2 or 3 years. I think it's fair to say that the Innovative Finance ISA hasn't been that wall of money yet. It doesn't mean that it won't come, but I think that growth will be steady. And most of the platforms that have grown over the last 2 to 3 years, it's been fueled by institutional capital who want to buy their loans. And I think that's a positive thing, because institutions can do a lot of DD on the platforms, and we're not going to let retail investors come in here and look through our loan files, but institutions will come in and kick the tyres and spend time with us and spend a lot of time getting to know us or other platforms.
So just emphasising that, there was an argument in the past, well, I still buy this, which is retail is good, and then one of the things about certain subsector of fintech was it was there to actually connect people to people and all that kind of stuff without the big, nasty, terrible institutions in the middle, yardy, and that still remains, although it's a much smaller part of it. And then there was an argument that moved on from that, was that, institutionals in there, they'll cherry pick the good stuff and, we'll be sort of screwed over and yada. And obviously organisations try and avoid that, because that's not really sort of very good for anybody. But you're making a further point, which is that actually if you're a listener acting as an individual and you're looking at a whole bunch of platforms, it's not a case that those that have got strong institutional flows are in any sense inferior. Vice versa, it gives you comfort because of their due diligence, that you've got professionals who've been in and kicked your tyres. And
exactly. It means actually it makes it easier that you're investing alongside professionals, if that makes sense, or people that know. I'm not saying retail investors don't know what they're doing, but people have had the opportunity to look in detail, who have credit expertise.
Credit expertise and literally the inside track, as in they come inside your thing and look around and all that. Actually looks very orderly out there, I must say. All very grey, actually, but that's London, pale white and grey. Yes, okay, so institutional thing, I buy that. A bit of libertarian part of me quite likes the bit of fintech that just connects people to people. But anyway, that's part of it. You can choose that if you want. But actually, if you're looking at sort of bunging your money somewhere, and if you're looking at bunging your money somewhere in your pension or your savings or whatever, I take your point that if there's decent institutional money in somewhere, then actually that means that some due diligence has been done. Okay, I've got that bit, and institutional has become more important, if only because in the modern world, money flows to institutions.
Yeah, exactly. And actually, if you look at inflows into funds, whether it be ISAs, stock market flows, pensions particularly because they're ageing, those inflows are just increasing in time. So actually there is, despite what we think, large fund managers are getting more assets. And the same is true for banks. And you can tell that by the rates they're offering on deposits. They don't really want that much more.
Yes, exactly. So if savings going up as they have to because borrowing goes up at the same time, then savings in general, of course, are with institutions, which banks are a subset because most savings aren't under the mattress these days. Okay, so I've got that then. Then what about this sort of more nuanced thing, which is one day a marketplace lender starts taking institutional funds after all, quotes, oh, we're selling out, institutional funds, da-da-da-da. Then after a while it finds that sort of, they're chunky money and it's a bit of a challenge and you're managing it all. But actually they help on the DD and they help the business because they come in and say, actually, do you realise that half your staff are not logging off the computer in the evening and someone can just wander up and ruin your whole business? Oh, didn't know that. Thank you very much, Mr. Institution. So how does it go from that to, let's just say, an extremist? And this hasn't happened with any, so this isn't an extremist, it's a caricature. How does that go to one day you suddenly wake up and you find that actually all you are is a front end from Goldman's because 100% of your money is coming from Goldman's and you're just doing buy-to-let mortgages or buying oranges and lemons and trading it or whatever the sort of market you're in?
I think if you're working with just one institution and they're 100%
So if you
capital,
dance with the devil, can you dance with the devil and still dance with hot chicks as well? Or does one day the devil take you over?
Or you dance with a lot of devils, to use an analogy. And I don't call any of our institution partners devils.
Exactly. I'm about to say that on your behalf.
To clarify that.
Angels.
Angels, exactly.
Dance
You dance
with the
with many
angels.
angels.
And you fall so much in love with the angels that you can't sort of tear yourself away from the angels.
Yeah, and I'm simplifying it now, really, but there's two, broadly speaking, different types of institutional capital, and there's probably more, but there's broadly speaking funds that actually, they've never been in this origination game, and they've generally ended up buying loans via other means, whether it be securitizations or whatever, and they don't know anything about origination of loans. It's not what they do. They're good at managing assets and gathering assets. And we've seen a number of those have actually decided to partner with various platforms and invest in loans directly. They've never been in the game of originating loans, and that pool, I think, is a large part of the current funding for marketplace platforms in the UK.
And their desire is presumably just for an asset class.
Yes.
They want return. Oh, look, there's 3.6% here, and it's a pretty secure thing.
Yeah.
We'll have some of that, please.
Yes.
They're not coming from the desire of, we want to get into buy-to-let mortgages or retail unsecured consumer lending or something. They just want a nice asset which has got a fantastic risk return.
They're a credit fund, fixed income, and they think actually this like I say, gives us 3%, 3.5%. We can leverage it and maybe get 5, 6, but that's what they're looking for, and it's fairly stable as well. And then there's the other side to what you said, which I think is also will probably become an increasingly important part, and actually you've seen it in the States where banks who are sitting on excess capital, and I think, as I mentioned to you before, that historically the level of savings and mortgages in the UK banking system was broadly speaking equal. Now the level of savings is about 250 billion greater than the level of mortgages. Now banks do more than mortgages, I accept that, but just as an indicator. And so they'll sit back and say, well, actually we've got very cheap capital, we're very good at originating certain types of loans, but actually we're not good at originating specialist buy-to-let or other types of loans, so we'll partner with someone, and effectively, like you say, we provide the capital, but we'll outsource our originating, underwriting, servicing. And you've seen that happen. We do it with one bank already. We can't name who they are, but publicly, Zopa have done it with Metro, Market Invoice have done it or doing it with Barclays. So I think you'll see more of those kind of partnerships between banks and platforms.
Right. As I recall from Metro, when they were on the podcast, and I may misremember this one, but Metro, I think, were falling into your category A, which is the time they didn't really do anything with all the sort of current account cash in terms of lending it out. So they just wanted to put it in somewhere. So they were coming from like a fund, shall we say. We've got some money. We want to stick it in some good risk return thing. So I think that was certainly their original intention.
But what I mean is that they're a bank and they had savings and they had a mortgage product. And so it may well be that bit where banks turn around and say, we'll do certain types of lending and other parts of lending we'll partner with someone else.
Exactly. Well, so anyway, the details don't particularly matter, but even taking a bank could, going back to my days about what we did with the capital of clients, purely take its capital and say, look, we want to stick this in a good asset rather than leaving it earning nothing in the bank. We're in our bank, we're in the Bank of England or whatever. We're going to bung it in something. That kind of bung it in something attitude. Separately, in a very different thing, so I think you answered my question by saying it's very discontinuous. There's a different group of people, and they say, we're a very large organisation, we can't do everything well. We've decided, actually, we don't do business line J and business line Q particularly well, but we still want to be in that kind of market, and actually, we will outsource J and Q to somebody else. It's not a good analogy, but it's a bit like sort of drug development. You know, the SmithKline Beecham and all these kind of huge ones aren't so good at drug development these days, so they kind of outsource that. So what you're seeing and what you're experiencing yourself and what you're doing yourself is some of that as well. So you take the retail money, you take the institutional funds that just want a good risk return, but you also increasingly, by the sound of it, acting as a front end.
Yeah, but it's all aspects. So it is the origination, the credit, and the servicing once those loans. So banks are effectively providing the capital, and they've outsourcing some of their, let's say, a business line of their lending operations or a particular product set even to us or to other platforms.
I see. And so just thinking this through my own mind, if I'm the bank, I'm not entirely sure from my experience how it differs that I've got a bunch of cash, I just bung it in something because it's a good thing to bung it in. And I'm head of UK banking, and I've got 24 business lines under me and decide 4 of them ain't that good and we're never going to be that good at them. And I outsource those. Why isn't that just the same? I've closed this business down internally and I've just got left with cash. I'm not quite sure how I, as Bank X, retain kind of my exposure to the market if I outsource almost all of it, as you're explaining.
Well, yes, and I think it would only be on a certain line that they do it, and they fund those loans, and they would be on what's called a forward flow basis. So over 2 to 3 years, they'd decide to make X amount of capital. So in some ways, it's exactly the same decision-making process that they would have around allocating capital between, say, buy-to-let mortgages and consumer. And it's a bit like thinking, from software development, do we make this ourselves or do we outsource it and use another partner? We're still going to end up with the same result in terms of the product, but actually it's whether we want that as a core competency and we want to just focus on consumer lending or residential mortgages or overdrafts or whatever.
Yes, exactly. So, just thinking through from my perspective, I think one of the answers might just simply be it's a different part, a different level of the organisation doing it.
Yes.
Because if you're the person running Metro Bank's balance sheet, we don't do loans and da-di-da-di-da-di. We've got 100 billion of current accounts. Oh, what do we do with 100 billion? And somebody right at the top of the organisation decides to bung some here, bung some there, and bung some there. In the case of the banking example, where I'm sort of at Bank X and I'm head of UK banking and I've got 24 business lines and 4 of them are no good, so I shut them down, I'm kind of doing it in a similar way, but maybe different, similar but different, which is that in my UK banking asset book, I don't want to have the specialised. I don't want all of my money in, unsecured consumer.
Yeah.
I want a little pie chart with loads of segments to diversify across different things. And therefore, I need to retain exposure to mortgages or something like that.
Yeah, and it may just be an economic decision where, particularly right now, residential mortgages, the rates are very, very low. And so actually for a bank to try and maintain their net interest margin, they might think, right, where can we go, which actually still is relatively low risk, where we can actually improve margins slightly bit. And we'd argue that our part of buy-to-let is one of those areas. And then maybe other areas like SME lending, invoice financing, and some aspects of consumer. So it may be a decision around diversification, but it also may be one around protection of margins as well.
Okay, so that's seeing it from the bank side. So seeing it from your side, from the marketplace lender side, about the difference of experience. The one thing you mentioned is this sort of, what do you call it, protected future cash flows or whatever, but basically predictable, yeah? So I come along to you, I'm Bank Y now, and I say, oh, John, I'd like to give you, 50 mil this year, 50 mil next year, and 50 mil the year after, and we sign contracts and I'm supposed to do that. That gives you a very predictable cash flow. Again, I'm caricaturing the extremes. Whereas I come along and I'm saying, I'm running out of letters of the alphabet, I'm fund E. Oh, here's 10 mil. Do you want 10 mil today? Oh, thanks. So I'll give you 10 mil today. and I come back next Wednesday and say, I'll change my mind, can I have it back? Is there a predictability of funds flow for you? Is there a differential predictability compared from a fund bunging you some money and then changing its mind 2 weeks later versus this sort of semi-outsourced bank thing?
Yeah, so in most cases, they'd act in a similar way, whereas they want to deploy capital over a period. That period may be a year, 2 years,
because
3 years.
These are illiquid assets, not tradable.
They're illiquid assets, and obviously they own the loan, so they can't get their money back until the loan repays, obviously. And most want to do it in scale, and so generally speaking, they would look to do it that way. We've never done it with a party where they said, right, we want to just 20 and then stop. There's one party actually we're having a conversation with that is actually talking about, it's a relatively small bank who says, actually, we might just want 20 million mortgages and then we'll come back another time. So there could be into that, but in most cases, we like to work where we're partnering over a defined period, 1, 2, 3 years, and we're deploying capital fairly consistently throughout that period.
Yes, and it occurred to me earlier in the conversation that something you were saying reminded me of a conversation I had with Kleinwatt's Treasury back in the day, or about 25 years ago or something like that. And the whole thing about Treasury is managing the predictability of your cash flows, because the more predictable your cash flows are just as an individual, the more you can plan for the future and manage it. The last thing you want is random cash flows. Well, if that conversation doesn't go well, John, then do send them to me, because I think actually there's a lot to be said for bunging 20 million to podcasting. I can certainly help diversify their portfolio significantly away from things like mortgages. So before we wrap up the show, I'd like to thank all the listeners out there. I'd like to thank my brand partners of the podcast, Blue Motor Finance, who are, according to the 2018 FT1000, the fastest growing FS business in Europe. Blue's award-winning technology has supported over $1 billion of lending, working with over 3,700 UK motor retailers. Smart Pension, who are fast, secure and free. Check out their UK workplace pensions at autoenrolment.co.uk. So we've mentioned Landbay once or twice in passing. I thought of a naff question, which I don't ask these naff questions, but it's good to come down off my sort of ivory tower and ask sort of naff questions sometimes. So what do you know now, John, that you didn't know 4 years ago? What would you tell the John 4 years ago?
It's a tough one, Mike. I'd say again, I think when we started, we thought the priority for the business was getting retail funding in. That was the focus. So, and we were actually, the origination side of it, the credit side of it, that is a lot harder, if that makes sense. So we probably would have invested a lot more in that. We definitely made some mistakes along the way, but I think all businesses do. I think with the benefit of hindsight, we would have probably got to where we did quicker if we'd known which road bumps we sort of hit along the way. But we work entirely with intermediaries now. We don't accept borrowers directly. We did at first, and actually I think we would have probably put a much bigger focus on that intermediary market and building a brand, a network, a presence in that market, if that makes sense, because that's where a lot of the investment's been over the last 18 months or so.
That's interesting. So I will not allow you to go back in time and tell your past self what sort of challenges are going to arise in the future, because that's life. I mean, I will only allow you to go back and tell your past self how differently he might play the game. And I think that point is then this brokerization or intermediarization, and certainly going back to how fintech has evolved. At the beginning, there was lots of fintechs, there still are loads and loads, all trying to reach the public. But that's a hell of an expensive job, and people like me wandering down the streets, or people who know even less than I do about fintech wandering on the streets around Victoria, they haven't got much headspace for 54 fintechs in their head. They're lucky if they can remember 2 or 3. I don't know my mum knows any, or my dad knows any. Or
I think actually we'll probably, over the course of 2019 and 2020, we'll push the retail peer-to-peer proposition sort of harder than we have done. And I think we will try and increase our presence in that market. And that's because now we feel we've got a track record we can stand back to, because whereas before we can't use the word safe for obvious reasons under the regulation, but now we can turn around and say, actually, we don't have to say whether it's low risk or not, but we've got 4.5 years of lending. We know what we're doing. Yes, we're going to make we are in a benign credit environment. We're going to have some defaults. We're going to have some arrears at some point. But actually, broadly speaking, we sort of know what we're doing.
Right, okay, so a quick flag wave for Landbay, for the thousands and tens of thousands and hundreds of thousands of listeners out there.
Yeah, so I said earlier, we're sticking to our knitting, we're staying within buy-to-let, we're growing all our sort of partners, particularly intermediary partners. So first of all, mortgage brokers who've never used us, please do. I think also, we're 55, 56 people now, we'll be probably just under 100 in a year's time, and making a big investment in technology. And, if there are listeners who are sitting in the EU right now, and we say this at the end of November, moving over to the UK between now and the March 26th means you probably get rights for life. So if there are smart developers out there who are thinking of coming to London, if you're going to do it, you're better to do it in the next 3 months.
That's a very good point. Right, well, we should definitely not end up on the BREXIT word, because that's kind of busy destroying the country and everybody's nerves and faith in democracy and roughly everything. So we'll not end on negative note like that, but however, I will end up where I started, which is that you've been spectacularly successful, not just spectacularly successful in terms of having knocked the ball out of the park or anything crazy like that, but you have solidly built a very solid business, and that's definitely to your credit. And you started talking about the main course about specialisation, and it occurred to me, hearing you talk, that if you take the most successful CEOs in fintech, the first sort of couple of dozen, and I think you must be one of them, then actually each of them will have some specialisation. I mean, maybe Samir, for example, at Desire, a funding supplement, is very good at setting a vision and long-term goals and all that kind of stuff. And you're clearly very good, and you've got lots of experience of recruiting the right people. And the trouble is, if you came up with sort of 6 different specialisations that people have got, then often people want to come on the podcast and tell the listeners how to run a good company. And I always resist that because it so much ends up with go to bed early, write a letter thanking your granny for the socks for Christmas, eat cabbage, don't swear, and all this nicey stuff. There's nothing wrong with that. But everybody knows that formula. Everybody knows you recruit a good team and da-da-da-da-da. But people's ability to do all these things, it's like school. It's like all the subjects of school. You're probably not equally good at all of them. And you've got a proven track record and been in the business of recruiting people. So you're bound to have an advantage of that. Whereas if I start a fintech tomorrow, of course it'd be amazing because I'm amazing myself. And I've done recruitment back in the day, but I have not spent as much time recruiting and interviewing people and all that kind of stuff. So that's an interesting one itself. And also actually sort of for VCs, because I'm not entirely sure that VCs necessarily have this model of specialisation, which is, this CEO is shit hot at A, B and C. He's not so good at D and F, but he's got a COO that manages that. So specialisation occurs across the board, and I look forward in 3 years' time, if you're not in, which will be 2021, we'll see whether we're still in the bloody EU or not by then. If you're not too grand by then to have me in whichever your offices are, you probably move around the corner to Buckingham Palace by then at this rate, and talking about how it's gone then and how your son is doing probably at university at that stage. Great, so thanks for that, John.
Thanks a lot, Mike.
Thanks for listening. If you have consulting, advisory/non-exec or media needs in the FS or fintech space, get in touch with me at mike@londonfintechpodcast.com.
We could sit in a vendor all day, watching the firelight dance, watching the firelight dance. We could walk in the mountains before dawn, watching a happy moonrise, watching a happy moonrise. Come away from the city, with the tarmac so dead and the people so sad. Come away from the city, with the faces so grey, with the pain of the everyday. We are wild like the mountains and the trees. Can you see what I mean? Can you see what I mean? We fit in between the earth and the sky. Kiss the city goodbye, wave the city goodbye, wave the city goodbye. The city goodbye. Watch the firelight dance with me. 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 Watch the firelight.